The banks just detonated silver from 30 Tau 50 to 2080 in a single trading session. They want you to believe this was natural market forces. They want you to believe fundamentals changed overnight. They are lying to you. And not just a little lie. This is a calculated algorithmic attack that borders on criminal market manipulation. What you're watching on your screen is not a correction. It's a crime scene. And the fingerprints are everywhere. Let me paint the picture of what just happened. On January 8th, 2026, silver opened at 30 Tau 50 per ounce. By the close of that same session, it had crashed to 2080. That's a $11.70 drop. In percentage terms, that's a 36% collapse in less than 8 hours of trading. Look at the chart on your screen right now. That vertical red line, that's not a market. That's an execution. Here's what they're not telling you. The physical silver market didn't change. Not one bit. Industrial demand from solar panel manufacturers, still there. Electric vehicle production requiring 1.2 ounces per car, still ramping. The 8,500 tons of silver used annually in photovoltaic cells. That demand didn't evaporate on January 8th, but the price smashed. If you are watching this video right now, you need to understand something critical. This wasn't retail investors selling. This wasn't even hedge funds repositioning. Between 2:14 a.m. and 2:22 a.m. EST, exactly 387 million ounces of paper silver contracts hit the COMEX exchange. That's 8 minutes. That volume represents more silver than Mexico mines in 6 months. Let me say that again. More paper silver than the world's largest silver-producing nation digs out of the ground in half a year was dumped on the market in 8 minutes. The mainstream financial media wants you to focus on the price. They'll show you the chart. They'll interview analysts who talk about profit-taking and technical levels breaking down. They'll use phrases like oversold conditions and momentum traders exiting positions. All distraction, all misdirection, all designed to keep your eyes away from the mechanics of what actually happened. But here's the critical data point they're burying on page 47 of the CFTC reports. At the exact moment this selling began, 3, not 10, not 20, 3 trading entities controlled 72% of the short position in silver futures. 3. That's not a market. That's a cartel. That's coordination. That's manipulation wearing a suit and tie. Now look at what happened to physical silver during this same period. Coin dealers reported their phones ringing nonstop. The U.S. Mint's allocation of silver eagles for January sold out in 43 hours after the crash. The spread between paper silver and physical silver coins, it exploded from $4.50 per ounce to $9.20 per ounce. Think about that disconnect. Paper says silver is worth $20.80, but to actually get silver in your hands, you're paying $30. Which price is real? The one on the screen or the one in your wallet? Wait until you see the hidden mechanism behind this crash. What I'm about to show you will shatter everything you thought you knew about precious metals markets. Wait until you see the hidden mechanism behind this crash. What I'm about to show you will shatter everything you thought you knew about precious metals markets. To understand why this crash represents a crisis event, you need to understand the anatomy of paper silver. Every silver futures contract on the COMEX represents 5,000 ounces of silver. When a bank or trading house sells a contract, they're promising to deliver 5,000 ounces at contract expiration. But here's the criminal part. They don't need to own any silver to sell that contract. The COMEX operates on fractional reserve principles. For every 100 ounces of paper silver traded, there are approximately 0.4 ounces of physical silver actually sitting in registered vaults ready for delivery. That's a leverage ratio of 250 to 1. Think about that math. If just 0.4% of paper contract holders demand physical delivery, the entire system collapses. On January 8th, those 3 entities I mentioned dumped 77,400 contracts onto the market in 8 minutes. That's 387 million ounces. The entire COMEX registered silver inventory on that day, 47.3 million ounces. They sold 8 times more silver than actually exists in deliverable form. This is how you smash a market. This is how you create a price that has zero connection to physical reality. Let's compare this to historical precedents. In 2011, silver hit $49.82 per ounce on April 25th. By May 1st, 6 days later, it had dropped to $33.20. That was a 33% crash. The trading pattern? Identical. Massive short positions concentrated in a handful of entities. Algorithmic selling in off hours when liquidity was thin. The difference? In 2011, it took 6 days. In 2026, it took 8 minutes. They've gotten better at this. More aggressive, more violent, more efficient at destroying price. Here's what Wall Street doesn't want you to know. Silver is not just a precious metal. It's the most conductive element for both electricity and heat. It's the only material that works in 5G antenna arrays without signal degradation. It's irreplaceable in medical antimicrobial applications. Hospitals use silver-embedded fabrics that reduce infections by 94%. And here's the extinction level problem. There are no substitutes. You cannot make a solar panel without silver paste. You cannot manufacture EV thermal management systems without silver-brazed components. You cannot build missile guidance systems without silver-cadmium batteries. The technical white papers from the Silver Institute document this clearly. Annual silver demand in 2026 is projected at 1.21 billion ounces. Annual silver mine production? 843 million ounces. That's a deficit of 367 million ounces every single year. This deficit is covered by above-ground supplies and recycling, but those above-ground supplies are depleting at 12% annually. The math here is brutal and non-negotiable. Now watch what happens when you layer financial demand on top of industrial demand. Central banks globally hold 34,191 tons of gold. You know how much silver they hold? 127 tons. That's a ratio of 274 to 1. But silver is being mined at a ratio of only 8 to 1 with gold. Do you see the distortion? Do you see the opportunity? Do you see why they have to smash the price before this realization goes mainstream? The banks are playing a paper game. Smart money is playing a physical game. And physical always beats paper when the music stops. In 1998, palladium traded at $180 per ounce, while automakers consumed it for catalytic converters. Nobody paid attention. By 2001, palladium hit $1,090 per ounce, a 505% gain in 3 years. What happened? Industrial users got caught short. They had to buy at any price. The paper market collapsed into the physical market. Chaos, shortages, production shutdowns. Silver is tracking the exact same pattern, the crash you just witnessed. That's the setup phase. That's the moment when weak hands panic sell. That's when institutions accumulate at suppressed prices. That's when smart money backs up the truck and loads up while dumb money runs for the exits. Your job, if you're watching this and you understand what's actually happening, is to recognize this for what it is, not a reason to sell, a reason to buy aggressively. And guess who was positioned for this exact moment? The names I'm about to reveal will shock you. This is where the real money is moving while retail panics. Let's talk about the extinction equation. This is simple math that creates massive consequences. Current annual silver demand, 1.21 billion ounces. Current annual mine supply, 843 million ounces. Deficit, 367 million ounces. That deficit is filled by recycling and above-ground inventories. But here's where it gets nightmare-level critical. Above-ground silver inventories globally are estimated at 2.1 billion ounces. Sounds like a lot, right? Wrong. Of that 2.1 billion, approximately 1.6 billion ounces are held in forms that are not readily available. Jewelry, silverware, religious artifacts, industrial products already in use. The available for market supply, around 500 million ounces. At current deficit rates, that's a 16-month supply. Now let's add the accelerants. Solar panel installations are projected to grow 28% year over year through 2030. Each megawatt of solar capacity requires approximately 2,000 ounces of silver. The global pipeline shows 847 gigawatts of new solar coming online by 2028. That's 1.69 billion ounces of silver demand just from solar in 3 years. Do the math. 843 million ounces mined annually times 3 years equals 2.52 billion ounces of total supply. Solar alone consumes 1.69 billion of that. Electric vehicles consume another 780 million ounces over that same period. Electronics and traditional industrial use, another 1.4 billion ounces. Let me make this crystal clear. Total supply over 3 years, 2.52 billion ounces. Solar demand, 1.69 billion. EV demand, 780 million. Traditional industrial, 1.4 billion. That's 3.87 billion ounces of demand against 2.52 billion ounces of supply. The deficit is 1.35 billion ounces. There is no silver for investment. There is no silver for jewelry. There is no silver for you. Do you see the problem yet? This isn't a market inefficiency. This is a physical impossibility being papered over by financial engineering. The last time this happened with a critical industrial metal was rhodium in 2020. Rhodium was trading at $2,400 per ounce in January 2019. By March 2021, it hit $2,980 per ounce. That's a 1,142% gain in 26 months. The cause? Automotive manufacturers needed it for catalytic converters. Supply couldn't meet demand. Price went vertical, brutally, violently, without mercy. Silver is setting up the exact same way, but with one critical difference. Rhodium annual demand is 31 tons. Silver annual demand is 37,640 tons. This isn't a niche market. This is a macro market with a micro supply. When this breaks, and it will break, the move will make rhodium look like a warm-up act. Here's what the patent filings reveal. Tesla submitted 47 patents between 2023 and 2025 related to silver-based thermal management systems for battery packs. Samsung filed 63 patents for silver nanowire transparent conductors for foldable displays. Siemens filed 28 patents for silver-copper alloy components in offshore wind turbine generators. These aren't theoretical. These are production-ready technologies consuming silver at scale, starting now. The industry reports from the Silver Institute project that by 2028, industrial demand alone will exceed total global mine supply. That means every ounce of recycled silver, every ounce from above-ground inventory, every ounce from government stockpiles will be needed just to meet industrial consumption. Investment demand, jewelry demand, they'll be bidding for scraps, and bidding violently. Wall Street watches COMEX screens. Smart money watches fabrication demand from industrial users. Chemistry beats spreadsheets. Physics beats algorithms. Scarcity beats paper promises. Every single time. The next 5 minutes will reveal the 3 lanes you need to survive what's coming. Miss this and you'll be left holding the bag. Now let's talk about the massive disconnect between paper price and physical reality. While the COMEX price crashed to $20.80, something fascinating happened in the physical market. Coin dealers across the United States reported the heaviest buying volume since March 2020. One dealer in Texas told me his January 8th sales were 940% higher than his average daily volume. A dealer in Ohio sold out his entire inventory of 90% silver coins in 4 hours. The U.S. Mint's numbers confirm this. They allocated 750,000 silver eagles for the first 2 weeks of January. After the crash, that allocation sold out in 43 hours. The premium on silver eagles, the amount above spot price that buyers pay, exploded from $4.50 to $9.20. So while paper silver traded at $20.80, actual silver eagles were selling for $30. Which market is telling the truth? The one controlled by 3 entities with massive short positions, or the one where real people exchange real money for real metal? This is the paper versus physical disconnect that always precedes explosive moves higher. In 1999, gold traded at $252 per ounce on paper, while physical gold jewelry in India sold at premiums of 15-20% above spot. Dumb money looked at the COMEX price and said gold was dead. Smart money looked at the physical demand and accumulated. By 2011, gold hit $1,921. That's a 662% gain for those who understood the disconnect. The banks count on your psychological weaknesses. They count on fear overriding logic. They count on price action overriding fundamentals. They execute these calculated algorithmic attacks specifically to trigger panic selling from weak hands. And it works. Retail investors see red candles and hit the sell button. Meanwhile, institutional buyers, the Teslas, the Samsungs, the Siemens of the world, are writing purchase orders for physical silver at these suppressed prices. Here's what the delivery data reveals. In December 2025, industrial users took delivery of 6.2 million ounces of physical silver from COMEX warehouses. In January 2026, after the crash, industrial delivery requests spiked to 11.8 million ounces. They're not scared. They're buying aggressively because they need the physical metal for production, and they know a crash like this is a gift. Think about the game theory here. The banks can sell unlimited paper contracts, but they cannot manufacture physical silver. Industrial users cannot operate with paper contracts. They need the actual metal to solder onto circuit boards, coat onto glass panels, braze into thermal management systems. When industrial users start standing for delivery in size, the paper game ends violently. Your job is to position yourself on the side that wins. Paper games are for traders. Physical accumulation is for wealth preservation. The paper market is manipulated. The physical market is real. Manipulation works until it doesn't. And when it breaks, the move happens faster than most people can react. You're watching this video right now, which means you have time, but that window is closing. In the next section, I'm revealing my specific 3-lane strategy. This is the exact playbook that protected wealth through every crash in history. Pay attention. Here's the 3-lane strategy for positioning yourself ahead of what's coming. This is not financial advice. I'm not your advisor. But this is the framework that smart money uses in every supply-demand crisis. Lane 1, physical silver. If you're going to own physical silver, weight beats art every single time. You want generic rounds and bars from recognized refiners, Sunshine Mint, Asahi, Valcambi, Perth Mint. Avoid numismatic coins unless you're a serious collector. That 1895 Morgan dollar in MS65 condition might be beautiful, but during a supply crisis, buyers want ounces, not collectability. Silver Eagles and Maple Leafs are fine, but you'll pay $6.09 premiums per ounce. Generic rounds carry $2.04 premiums. Over 100 ounces, that difference is $400 or $500. Stack ounces, premiums are dead money. Focus on accumulating weight at the lowest cost per ounce. Storage is critical. If you don't hold it, you don't own it. Safety deposit boxes are an option, but during financial crises, banks can restrict access. Home safes work if properly secured and insured. Allocated storage with private vaults like Brinks or Loomis offers insurance and auditability. Never, and I mean never, store physical metal with the same entity you bought it from unless it's fully allocated and audited. Lane 2, unhedged silver miners. If you're going to play mining stocks, the criteria are simple. Unhedged production only. A hedge miner has sold future production at fixed prices. When silver goes from $21 to $60, that miner doesn't participate in the upside. They're locked into selling at $28 because they hedged. That's a disaster. Look for miners with low all-in sustaining costs. Under $70 per ounce is the target. Look for increasing production profiles. Mines ramping up, not winding down. Look for jurisdictions that are mining friendly. Nevada, Mexico, Peru, Australia. Avoid jurisdictions with nationalization risk or political instability. Here's the warning. Do not buy miners that are actually exploration companies dressed up as miners. If a company has resources but no reserves, that's an exploration play. If they're drilling holes but not pulling ore out of the ground, that's exploration. You want production, you want cash flow, you want companies that sell silver into the market every quarter. Lane 3, geographic diversification and timeline. Accumulate now while prices are suppressed. Hold through the mania phase. This is a multi-year setup, not a momentum trade. The move from supply deficit to price explosion typically takes 18 to 36 months from the first major crash. We're at month 0 right now. January 8th, 2026 was the starting gun. Do not make the mistake of selling into the first 20% bounce. Weak hands sell the bounce. Strong hands add to positions on pullbacks. Imagine if you had sold gold at $400 in 2005 after it doubled from $200. You'd have missed the move to $1,900. Patience gets rewarded, panic gets punished. The strategy is simple. Accumulate physical, position in unhedged producers, hold through volatility, trust the fundamentals. Supply and demand are physics. Physics always wins. The specific price target and timeline I'm about to share has 90% historical accuracy based on previous supply crisis commodities. Pay close attention to these numbers. Let me summarize what's happening in one sentence. The largest single-session crash in silver just created the buying opportunity of the decade, while industrial supply deficits accelerate toward a breaking point. This changes everything, because what you witnessed on January 8th wasn't a market-finding equilibrium. It was suppression before explosion. It was accumulation disguised as capitulation. It was smart money positioning while dumb money panicked. Here's your last chance moment. Before the solar industry realizes they're 6 months away from silver shortages, before the EV manufacturers start bidding against each other for supply, before the jewelry industry in India discovers they cannot source enough silver for wedding season, before the investment world wakes up to a 367 million ounce annual deficit, before any of that recognition happens, you have a window. Right now, this video, this moment. I'm going to give you my specific prediction. Based on the supply-demand fundamentals, based on historical precedents from palladium and rhodium, based on the industrial consumption trajectory and mine supply constraints, I predict silver will trade at $85 per ounce by Q4 2026. That's a 308% gain from the crash price of $20.80. And I predict the move will execute violently, not a steady climb, a vertical spike. When the paper market breaks and physical delivery demands overwhelm the COMEX, the repricing happens in days, not months. The timeline is tight. By April 2026, the solar industry's Q2 procurement cycle begins. By June 2026, the above-ground inventory data becomes public and undeniable. By September 2026, the first production shutdowns from silver shortages hit mainstream news. By November 2026, the price has already made the majority of the move. You're either positioned before April or you're chasing momentum after June. To everyone watching this who understands what's happening, you are the enlightened. You are the ones who see through the manipulation. You are the diamond hands who hold while others panic. Stay positioned. Hold through the volatility. Trust the fundamentals. The periodic table doesn't lie. Physics doesn't manipulate. Scarcity doesn't negotiate. The banks play paper games. You play the physical game. Chemistry always beats finance. Every time, without exception. That subscribe button below, that's your reminder that we're tracking this story as it unfolds. The next phase is going to be explosive, and you're going to want to be here for it.